Hello, welcome to this webinar on our latest investment offering. This is on a Class B multifamily deal here in Kansas City called the Madison in Overland Park. Very excited to share this with you. We have scoured hundreds and hundreds of deals to find really what we believe to be kind of needle in the haystack deal in this current environment. And I'm going to explain why, but it's got some really compelling features that make this a really great risk-adjusted opportunity for investing right now. So with that, we're going to dive right in. First, got to give the disclaimer. This is not an offer to sell securities. You got to review our full private placement memorandum to review all the risk factors. And I may make forward-looking statements, but there's no guarantees of those returns. You may be familiar with some of these faces if you've been following us for a while. This is kind of our two co-founders, Bob and Jim. And then our other partners are Dan Schulte and myself. And I'm not going to go into our backgrounds a whole lot just for the sake of time, really focusing on this deal. We have a lot of information about our team if you'd like to learn more about us, but let's kind of get into our co-sponsor team here. So Elevate, this is a group that's based out of Dallas, Texas. We actually were brought in this deal and then brought Elevate into this deal. We were co-GPs with them on another deal in Northwest Arkansas that we purchased earlier this year. That's actually very similar to this deal that is performing very well. We've been very impressed with this group and are kind of bringing them in to help just bring a very high level of experience and expertise into this deal. They have over $500 million assets under management, have exited over 1,600 units, have acquired nearly 7,000 units, all multifamily. And so really excited to have another deal to partner with them. They are vertically integrated, which adds a lot of kind of great efficiencies to this deal. So, real quick, if you're kind of newer to how Aspen works, we are unique in that we are not a hammer and everything is a nail. We're not a one-trick pony that's just doing one asset class. We're looking across the landscape of investment opportunities and finding the best risk-adjusted opportunities, really driven by what we believe to be key macroeconomic trends that are in play and likely to continue for a period of time. And then we look at the best asset classes, best strategies that are going to benefit from those trends. And then we put in together the best-in-class teams, really good structures for investors. And then we put our money where our mouth is. And we, as a management team, all four partners, invest in every single deal that we bring to our investors right alongside our LPs for just, full alignment of interests. And, making sure we're bought in and we're only going to present deals that we're super excited about. So here's a little bit of our track record, been on the Inc. 5000 for many years. We're actually approaching about $200 million in capital, equity raise from investors, and almost approaching close to $500 million in assets under management as well. And my favorite number is the one on the far right, $50 million in investor distributions since inception. So that's something we're very proud of, that we not only raise money, but we actually return profits and principal back to investors. And we have a full track record that you can review on individual deals in our data room if you'd like to get more specific into all the deals that we've done over the past almost 11 years now. We've experienced across many asset classes, like I said. So multifamily is one vertical that we're still bullish on, and I'm going to explain why here in a minute. And lastly, a final shout out for our podcast. If you're not already a listener, you should be, because we talk a lot about the different trends going on. We talk about just general investor education, how to become a better investor, and really, learning to invest like the ultra wealthy, invest like a billionaire. That's our goal with that podcast. I encourage you to check it out if you haven't already. Okay, so let's dive into the deal. All right. So this is where it gets fun. And again, this is something that we have spent countless hours talking with tons of different sponsors, talking with and evaluating tons of different markets. And this is the only one that has passed the test this year. We did purchase one earlier in January called Watercolors in Northwest Arkansas, which is a Class A lease-up play, and it's going very well. This one is very similar, although this is actually in our backyard. This is in Kansas City. This is in Overland Park, which is the best submarket. I'm going to get into all the details here in a minute. And ironically, I actually went to high school just like 5 minutes from this property, know the area very, very well. And it's a beautiful property. It's a Class B property. I would say it's really B plus, really in A+ location. This is one of the best locations in the best submarket in Kansas City. So, location, location, location. That's the colloquialism of real estate, and this has it. We're going to get into all the details here, but this is a 200 unit Class B value add multifamily property. This was built in 1999. And it's in Overland Park, which is the most affluent and most desirable submarkets of Kansas City. This property has been under renovated and underpriced. Actually got a really good deal on this from a price per unit standpoint. It's next to one of the largest shopping areas right next door. It's also got access to the best school district in Kansas. And then here's kind of the cherry on top that we just absolutely love about this is it's got a assumable Fannie Mae loan with a 3.9% fixed interest rate. So I'm going to get into all the details here in a little bit, but this is, again, one of the reasons why this acquisition is we're so excited about it. So I already mentioned this. What are some of the key reasons that you want to invest in this property? And then we're going to get into all the specifics. But again, location. You can't replace location. That's the one thing you can't change when you buy real estate. And for multifamily, this is so important. So this is a B+ asset in an A location, near prime shopping, and in the best school district. So if the way that it works here in Kansas is if you want to be in the school district, it's a high price point to purchase. And so a lot of times the best option is to rent to get access to the school district. One of the great things about this property is these are large townhome units with garages. And so, for those renters that, want a little bit more of a home-like feel, these are very large units. They're townhomes. They got garages, very highly desirable for renters. Obviously, with a 3.9% interest rate that's assumable from Fannie, this is extremely attractive, and it makes this deal, really, really valuable because of this low in-place financing. It reduces our risk and kind of the renovation plan and the carry costs associated with that, kind of in this current environment. And we've stressed this test. We stress tested this deal a lot. I'm going to talk about that in a little bit. About all the different options we have to kind of hold on to this asset or sell early. We have a proven value add plan. So this is another thing that we just love about this deal, right? So it's 200 units. 112 of the units have already been renovated, and the current occupancy is in the mid to high 90s right now. And on several of the units, on the renovated units, they're already hitting our pro forma rents. So the business plan is already being achieved, and it's already been proven out in this market. And so the risk is much lower from kind of a, heavy repositioning. This is, only renovating 44% of the units. Other units are already getting the same rents that our pro forma is. And the other kind of piece of this that's really, really important that is unique in this submarket relative to a lot of other submarkets, which I'll talk about in a minute, is there's very limited supply coming in. There's just not a whole lot of new areas to build in this submarket. It's pretty well developed, and pretty much the only supply coming online is for senior housing or senior living facilities, not kind of true townhome and kind of Class B mid-tier housing. One of the other attractive things we like about this, a shorter term business plan. So this will be a 3 to 5 year hold, where our initial time period is planning on selling this in year 3. But we have contingency plans. We've stressed this, like I mentioned, a lot of different ways to be able to refinance into a longer term hold if we need to. If the market is soft at that point in 3 years, we have a lot of room, a lot of margin to go and refinance at a healthy position. And hold this asset for longer and ride the benefits of potentially longer term inflation. Just like always, we're investing right alongside all of our investors. So our management team, as well as the other co-GPs, we're investing at least 5% of the total equity into this deal, and right alongside of our investors as LPs. We're also going to be guaranteeing the debt from Fannie Mae. So we're signing on the dotted line for kind of further alignment. And one of the great things too is this asset will close in 2023. So there will be a cost segregation study performed. And this year, there's still 80% bonus depreciation allowed. Next year, that goes down to 60%. So if you're looking for any kind of tax losses, you want to get into this asset because it is going to close by year end. and we'll be able to provide those tax losses this year for you before it drops down to 60%. We have two share classes in this deal. We have a $50,000 minimum, and then we have a $500,000 minimum. So the only difference there is really your preferred return and your splits. So on the Class A shares, 7% preferred return, and then a 70-30 split. The Class B, it's going to be 8%, and then an 80-20 split. So the returns are slightly better in the Class B because of the better kind of economics, but we're kind of targeting a 16 to 20% IRR, annual return. And the IRRs are going to be actually slightly lower than that. And then the cash on cash, we're targeting kind of 4 to 7% throughout the hold period, targeting a equity multiple of 1.7 to 2.0. And then again, our hold period is going to be a 3 to 5 year hold period. We have two ways to invest in this deal. So you may have seen the launch of our opportunity fund. This is a great option for investors that want to invest one time and get access to kind of all the different deals that we're doing over the course of the year. And we've already got several assets that are, really awesome in the fund already. And so by investing into that fund, you're going to get exposure to this asset class or to this specific asset alongside the other assets that are already in the fund. This fund will invest directly alongside the syndication, not within the syndication. So there won't be multiple layers of fees. It's going to be one layer of fees. And you're going to get better diversification with that single, dollar amount going into the fund. Some of our investors prefer just to invest directly into the deals. We're still allowing that. And so you can do that if you like and kind of choose your own allocation strategy. But if you like, just the kind of passive approach, get the diversification with the single check, get a single K1, get access to multiple deals, the fund is a great way to go. Okay, let's talk a little bit about macro trends. If you know us, we care a lot about the big trends going on because we believe the tailwinds and the rising tide that floats all boats is as important or more important than the specific deals and strategies related in those, because you can't fight the headwinds if they're in front of you, right? It's a losing battle, and so you got to be in position in the right areas. And there's some challenges in multifamily. We got to be honest, right? There's a lot of things going on that are challenging, but right now, we actually believe it's a really good time to be buying because one, there's less competition. We're actually seeing some softness in pricing right now. And then with this in-place financing allows us to kind of ride out the next several years in a really good market with really high occupancy and then have a whole lot of options. But we know for a fact that multifamily is one of the best ways to hedge against inflation. And so we believe inflation is going to be around for a while. This is a great place to be. And if you look at, one of the kind of core theses that we believe is that there is a structural shortage of housing units relative to population. So this is both single family and multifamily. And you can see here kind of the trend line has definitely been going down over the past, this is really, 40 years worth of data. And that is, adjusted for population. And so as populations continue to increase, we have seen construction, but not at the same rate. And so we believe there's going to be a lot of opportunities because there is still a structural shortage of housing. That's going to continue to put pressure on rents. And that's what we're seeing right now. And so this is kind of a comparison of, renting versus home ownership. And you can kind of see here, there's always kind of been a trend, where there's a spread of kind of average effective rent relative to monthly payment of home. You can see in the past few quarters, the cost of a mortgage has spiked, massively spiked. And so that is putting a lot of support and kind of a tailwind behind, rents going higher. So we believe that rents and home prices even are going to continue to march higher as there's this kind of structural shortage. But then even right now, as interest rates are high and what we believe likely to remain higher for longer, will continue to be a boon and support to rents in really good markets. Here's a really interesting thing too. So obviously there's kind of cost prohibitive aspects to not buying a house, and people will have to rent, they're forced to rent. But we're also seeing a shift to lifestyle choices toward renting that we've been seeing for a few years, but continues to be very strong. So this was an article that came out in the Wall Street Journal a few months ago. 3 million U.S. households making over $150,000 are still renters. And so one of this is being driven by cost and prohibitive costs of a mortgage, but also choices of lifestyle, which is a report that was just released by RealPage. This is just last month, August or 2 months ago. They surveyed with 2,000 renters, and very interestingly, the costs are prohibitive, but also the lifestyle preferences of renters are driving demand. So 70% of renters are bullish on the state of renting today, which is really interesting. 66%, so 2/3 are happy with their current housing situation, meaning the renting, and they actually prefer the lifestyle freedom that affords them versus owning a home. So 2/3 of renters are happy with where they're at renting, and they actually like that and prefer that over owning. And 73% of renters want to or get to live in neighborhoods that they otherwise couldn't afford to buy in, right? So this is so critical because you think about, especially right now, as access and the cost of homeownership has skyrocketed. Well, if you have kids, you want to be in a good school district like this particular property is, your best option, for the certain echelon of renters is to rent and not to buy. Midwest is it's really a standout markets right now. So a lot of the Sunbelt markets, coastal markets are having challenges. And so you're actually seeing rent declines in a lot of markets. But the blue here, the darker the blue, the higher the rent growth year over year. This is as of August of this year. And so this is year over year change in median state rents. You can see Kansas here is on the upper end of that range. This is from another source called Rent Cafe. They are tracking rents across the 50 largest metros by population. This is as of August as well. Kansas City has had the second highest year-over-year rent increases, right? So a lot of markets you've been hearing about, oh, rents are declining. Not in Kansas City, not in Kansas City, and not in a lot of these Midwest markets. You can go down the list here. Most all these are Midwest markets. Again, Kansas City is well positioned. This is top 10 cities as of September for rental activities. This is new leases being signed. Kansas City is number 2 on the list. So obviously that's the macro picture. That's what's driving this, right? There's some challenges, but there's some real sweet spots, and there's some really attractive things that you can be looking for right now to find really good risk-adjusted investments into multifamily. So Kansas City, if you're not familiar, this is a huge metro, a lot of diversity in employment. It's got very positive population growth, has for the past several decades, great demographics. We've seen really good growth across a lot of sectors. Overland Park, so this is the specific submarket of Kansas City, is on the Kansas side of Kansas City, is ranked the number 1 best city for median annual income, adjusted for cost of living, and number 29 for best cities for jobs in the U.S. It's known for very low unemployment. You can see here, unemployment is under 2.1%. 2.5% as of May of this year, relative to the broader unemployment rate over across the board. We've seen strong population growth. It's actually up over 14% since 2010. And we're seeing, very strong incomes and rises in home prices here. So it's just a very, very strong market here. We have a lot of things going on. So aside from the Kansas City Chiefs and really good barbecue, we have a lot of really big developments going on that are just continuing to attract bigger and bigger companies and jobs being brought to the city here. So we've got, I'm not going to list all these, but you can go through this if you'd like. So the specific locations, so you can see here in the picture, the Madison Overland Park here. It's right by one of the main highways in Kansas City, South Kansas City, which is Highway 69. It's great highway access to kind of get anywhere in the city. And then you can see just kind of the top right there in that little map, Corbin Park. That's one of the largest shopping centers in the kind of South Kansas City corridor, access to every restaurant, retailer that you'd want to be by. So just a really good, it's got an A+ grade from niche.com for just the zip code and just all the amenities and access to things we've got. It's Blue Valley. It's the number 1 school district in Kansas. It's in the top 70 in America. And tops the board in Kansas across multiple factors from just desirability. A great household income. So our 1 mile is 105,000 roughly. 3 miles, 127,000 median household income. Very strong population growth and really strong household formation. It's actually projected household growth. So we're seeing in a 1 mile radius almost a 5% household growth. So this is not just population, but actually households forming and moving into this area, which is a huge driver of needing for housing and apartments. Here's all the retail. I'm not going to go into all this. Here's some of the employers. So just a ton of great options. If you want to be in Kansas City, this is a great place to be. Let's get the property. So we do have a drone video. You can see the property in live action video with some of our investor relations team members talking about the business plan and about the property. So you can watch that. This will be linked in the data room. And also if you download the deck, you can click on the link here to watch that. But here's kind of a classic, Class B value add renovation plan. A lot of these older units have tile flooring. They have, old appliance packages, outdated cabinetry, a lot of carpet. So we're going to just improve this. We're going to do a lot of just the basic stuff. We're going to put in nicer flooring. We're going to put in rock countertops. We're going to put in stainless steel appliances. We're going to just improve lighting. We're going to paint it and freshen it up. Several of these are 3-story townhouses. So they're just really spacious, really nice. A lot of just the basic upgrades for this kind of Class B, middle higher end product. We're going to modernize a lot of things, add some ceiling fans. Exterior, this is a 1999 build, so there's not a whole lot of CapEx that needs to be done. These are obviously pitched roofs, and 18 of them were replaced just a couple of years ago. So we've got this kind of nice brick. I actually really, really like the look of this, but we're considering potentially painting it just to even freshen up a little bit more, modernize it. And just kind of do some of the basic CapEx stuff, just improve, some of the concrete areas, the main areas, and just the biggest thing that it needs is just updated landscaping. Their irrigation system went down, so we're going to repair the irrigation system and just improve the grounds. We're going to add a couple other amenities, potentially a pickleball court, and just improve the kind of outdoor patio seating area around the pool. And so just kind of improve the community feel, just improve the signage. It's kind of an outdated sign. So just, really showcase how awesome this property is. It's a very sprawling property. You kind of walk it, it's quiet, it's nice, it's very, very spacious. Just a great, great spot. You can see some of the amenities here. So we're going to improve the swimming pool with a sun deck. We're going to improve the clubhouse of the business center and some offices. We have a fitness center. We're going to kind of prove this actually gets used a lot. So we're going to make that a little bit nicer, a little more spacious. And we have a lot of green space. And so, we're going to kind of improve some of the park area, the dog park, add a pickleball court in, add some new furniture for the pool. So a lot of this basic, simple stuff just to improve the overall community feel of this that we've seen at other properties is working really well for this type of a tenant base. So we think it'll just continue to attract the right tenants. So here's kind of our pro forma unit mix. In place average rents are just under $1,600. We're going to just over $2,000 in the pro forma. But as I already said, several of the units that are not even renovated to the level that we're going to renovate them, because it's kind of a Gen 1 renovated units that they don't have stainless steel, and they're probably not as nice as we're going to make the kind of next phase or the kind of Gen 2 version of them. But those are already hitting the pro forma rents that we're expecting on the little bit nicer Gen 2 version that we're going to be making. So again, there's just a lot of demand. Occupancy in this market is extremely high, and just a lot of rental demand. So we have very high confidence in these rents. We actually believe there's quite a bit of upside in these rents that we're not modeling in because we want to be conservative and we don't want to go in with too aggressive a business plan in this market, but we have confidence in the numbers that we're showing here. So we're buying this at about $221,000 per unit. We have a lot of comps over the past several years, even this year, that are well above this with similar vintages. So we feel very good about our price per unit number. We actually already have comps that our exit price number when we're selling this in 3 to 5 years. So that's also encouraging to see. So there's been a precedent set at that kind of price per unit standpoint. You can see some rent comparables analysis. We got an extensive rent comp analysis done that you can review in our underwriting spreadsheet. So under the rent comparables, you can see here, and we kind of summed that up in this table here. But on a price per square foot standpoint and an absolute rent standpoint, we're right in line, if not below, a lot of the market right now. So we feel really good about where these numbers are coming in at. Here's our snapshot of our CapEx budget. We're planning on spending on the 88 units left to be renovated, about $14,000 per unit, which given other renovations we've been completing in other properties here in Kansas City, we feel like that's a really comfortable number to kind of hit what we need to hit with some of the basic things. But some of the big ones, we're adding stainless steel appliances, we're adding quartz countertops, and fresh paint, nice flooring. So it's really going to just brighten up, freshen up these units and make them really desirable given the size they are. Our plan here is to kind of, even though we have to renovate 44% of the units, we can kind of blaze through that. We're targeting an 18-month kind of period to renovate all those and to kind of stabilize back up to the occupancy we want to hit. We have 3 years left on the Fannie Mae loan that we've assumed. We've also are bringing in some preferred equity to kind of bring us up to about a 70% total combined loan to value. So we're bringing in, about 30% of common equity into this investment. And so in year 3, if the market's soft, it's not a good time to sell. We think, year 3, we're probably going to be having some rates be dropping at that point. Inflation, we think, is going to continue to do its work and going to continue to put a lot of upside potential into rents. We think it's a great place to be positioned right now, especially in this market with this location. And then if we can't sell, we've stressed this pretty substantially to where, we can miss on our gross potential rent targets. We can miss on our cap rate. We can miss on our operating expense. We can miss on a lot of different areas and still fully clear our capital stack and refinance into long-term agency debt at low leverage ratios, and even stress this to 8 to 10% interest rates on a refinance, just to have a contingency plan to sell this. So there's just a lot of a margin in this business plan to get out to an exit or a refinance recapitalization if we can't exit in that time frame. Again, this is kind of our value add program, going to just improve some of the amenities, some of the interiors, and feel really good about that. Here's kind of our annualized pro forma. You can review this in detail if you like. One thing I want to note, I'm going to have all the assumptions here on the next page, but we feel obviously good about the top line income, but we've also been very conservative on our operating expenses. And, we're not the ones that come in and say, oh yeah, we're going to drop expenses by 20% because we can run it better than the last guy. We don't think that's realistic, right? And we've, acquired a lot of these types of properties, and that's just generally not the case. You don't usually come in and you find those kind of savings. And so we're very conservative here. We actually have our expenses increasing versus the trailing 12-month numbers. And we're trying to be conservative on all levels from a real estate tax standpoint. We have insurance quotes in hand that we're basing our numbers off of. We've got, all the kind of other pieces of this in a really good, range, and kind of stabilizing the operating expenses. Like I said before, this will be closing in 2023. So we are expecting to run a cost segregation study. We'll take advantage of the 80% bonus depreciation this year before it's reduced next year. And so if you are looking for some tax advantages, I definitely encourage you to review this deal and see if it kind of fits your investment goals, and lock in some tax losses for this year. And again, this is really excited about this deal, and we have some time. We're going to be planning on closing end of November, so we've got a little bit of time, but we are on a tight time frame to kind of get this deal closed. So if you are interested, please reach out to our team ASAP. We have a lot of groups looking at this, even institutional groups. So we expect the kind of equity to fill up pretty quick because we do have several groups that are raising capital for this group. for this property and feel really good about where it's at. So, with all the attractive dynamics of the attractive financing, proven value add business plan, great location in our backyard, we think this is a great addition to the investment portfolio. So please reach out to our team ASAP. Submit your soft reserve on the link below to lock in your spot, and then reach out and schedule a time with our investor relations team to answer any additional questions you may have. You can review the full underwriting here in the data room, and appreciate you taking the time to watch this webinar.